Welcome to this Killick Explains video. This week I want to take something on which has been in the news quite a bit recently. That is the issue of negative interest rates. Will the Bank of England reduce rates below zero? What would be the consequences and why here is that something that can make quite a few investors a bit nervous? Okay, so as usual, a little bit of background on this topic first of all. Interest rates are already at record low levels close to zero. Anyone who's tried to find a bank deposit account paying anything like a half-decent rate will have struggled. They will know that across the board interest rates are being cut. And that's because the rate against which they're all benchmarked, the so-called Bank of England bank rate, is also being cut. So now we're down to a rate at the time of filming just above zero, which is why savings rates are so poor, and mortgage rates on the flip side quite low too. And this may turn negative, and that's what's worrying many commentators. Now you might think, well, if it goes negative, that's just an extension of where we are now. But actually, it has two or three ramifications. Now a quick recap on negative rates in general, and then we'll dive into those three reasons to be nervous. So first of all, in principle, as I mentioned, a negative rate is just an extension. Once you have cut interest rates to nearly zero, you can then go to zero, and then you've got no choice if you want to go further with monetary stimulus than to cut below zero. Now, some analysts think, well, and so far, so what? Surely that's just a logical extension of a pattern that's been established by central banks for years. And the aim is simple. You want to discourage savers by removing any prospect of earning interest on their capital and ideally encourage borrowing, the logic being that if retail investors and companies borrow, then that will help to drive some economic growth. But would it work? And why are investors particularly nervous as we hit that crossover point between positive and negative? First of all, there's a psychological hurdle here. Now what I mean by that, you can probably guess, is when rates go below zero, strange things start to happen which are logical, but we're not particularly used to seeing them. So you get a situation where lenders are suddenly paying borrowers, if you like. So you are putting your money into a bank account with a negative interest rate and paying a bank effectively for the privilege of keeping it there, which does turn the world a little bit on its head. So holding cash on deposit actually costs money. And you might say, well, that will stimulate people to spend it. But actually, it might stimulate them to get even more nervous and hoard, ironically, even more than they were before. This is not something we're used to seeing, basically. So it's psychologically quite difficult for people to adapt to negative rates, even if mathematically it's a straightforward enough concept. Number two, the practical hurdle, as I've called it, and there are three of these in total. So the practical hurdle is lockdown has pushed people into spending less and saving more in the main. I mean, there are exceptions. Some people have found themselves with surplus cash, if you like. Retail sales have held up relatively well, but that's been a broad pattern. People have retrenched a bit, basically. A cut in interest rates may not change that very much, if at all. So there is this issue of what are you trying to achieve? Are you trying to boost spending, reduce saving? Would negative rates achieve that? And as ex-Bank of England Governor Mervyn King has put it, are people realistically going to suddenly start booking meals out at restaurants, even if the tier rules allow them to do so, based on a 50 basis point cut in interest rates? We might have reached the point where that's pretty much giving away an interest rate cut for no tangible result. And then there's what I call the banking hurdle. Now, some people won't have a huge amount of sympathy for retail banks, but there is a problem here nonetheless. Basically, banks make money by lending money out, very simple, at a higher rate than they offer on deposits. It's called saving and lending. I'm talking about retail high street banks here, not the investment banks that make money a whole host of other ways through trading, M&A, IPOs and so on. So basic bread and butter retail banking. You collect money from savers, you pay a little bit of a rate on it, and you hope to lend money out to mortgage borrowers and companies at a higher rate. The difference is your margin, if you like. Well, so far, so what? Thanks for the lesson in retail banking, Tim. Well, with downward pressure on lending rates, negative rates may actually hit profitability because essentially it squeezes the bank's ability to actually make anything out of that gap. You might think mechanically, how can that be? But actually in practical cases, by reducing rates much further, you're just squeezing retail banks even harder. And bank share prices, therefore, not surprisingly, in most cases, talking about retail banks, not the Goldman Sachs, not the JP Morgans here, are already below net asset value in many cases. So some people have said you're just making a bad retail model worse for no obvious gain when it comes to stimulating consumer demand and so on. So in short, what are my conclusions? What are my summary points on this one? Well, negative rates are in theory just a logical next step, but they could further weaken retail banks that are already struggling. So from an investor's point of view, it's kind of, why would you do that without changing consumer or business behaviour very much? So that's the kind of, have we reached the point where maybe we're running out of gas on this particular way of trying to stimulate the economy? And that's where people start to offer an alternative. So what else could they do? And I'll just put this out there. I'm not going to give a didactic view here, but basically governments are seeking still to try and stimulate demand, get us through this pandemic. So an alternative to constantly cutting interest rates and printing money, if you like, monetary stimulus, is fiscal. So some people have put it out there that governments could borrow long term at these ultra low interest rates we're seeing, and then directly support businesses and consumers. And of course we've seen some of that from the UK Treasury, and some people are saying, frankly, rather than cutting rates, more money printing, that is a more plausible route, and it can be funded at a relatively low cost right now, rather than A, squeezing retail banks, and B, frankly, not achieving much in the process. So my two pennies in summary would be Mervyn King, and he's just one of the more high-profile people who've put this view across. It's probably right to question whether further interest rate cuts and monetary stimulus are the way forward, especially when you're taking people into a negative interest rate territory. Some analysts favour more fiscal support. There is a downside. This is why I said I wouldn't be didactic. Fiscal support arguably props up zombie companies. It gives help to companies that arguably shouldn't have it, and it brings forward arguably the day when inevitably Rishi Sunak's going to have to work out how to pay for all this stuff through, well, who knows, tax rises seem quite likely. So investors are wondering, as the background to all this, at what point central banks and states run out of ways to simply pump money into the economy and defer what could be some inevitable pain that at some point will need to be absorbed. Any questions? editor@killick.com. And if you'd like to see videos on some of those terms I mentioned, monetary policy, quantitative easing and so on, then killick.com/learn, and you could go to the Investing Principles tab for those videos.